So welcome, everyone. My name is Peter Young. I'm the CEO and managing director at Young& Partners. We're a chemicals and life science investment bank and strategy consulting firm. And I'm very pleased to welcome you to this Young& Partners Forum broadcast, which will be a conversation that Rob Westervelt, who is the editor-in-chief of Chemical Week, and I will have on what is the future outlook? What's the future outlook? Um, this is a very interesting time to have the webcast on this issue because there's so many disruptive things that are happening, both in the industry and more broadly geopolitical and so forth. And when we thought everything was pretty challenging, then last Saturday we had the events in the Middle East, and so it made it. We had added one more serious geopolitical issue to arise. Uh, Rob doesn't really need much of an introduction, but I will anyway. Rob has been the long-term editor-in-chief of Chemical Week. We all recognize that Chemical Week is one of the leading periodicals and web presence focused on issues that are important to the C-suite in the chemical industry globally. I've known Rob for quite a long time, right, Rob?
Yeah,
Uh,
coming up
uh,
on 30 years. Yeah.
Maybe 30 years or so,
Yep.
which I guess is good, right?
Yep.
Uh,
Indeed.
but I really felt that he was ideal as a conversationalist on this because his magazine covers all these different topics, whether it's capacity utilization or global events or geopolitical shifts and so forth. In my case, Young Partners serves chemical companies around the globe. We do investment banking of all types. We do strategy consulting, and we also do projects that combine the two. And we're unique there because we're the only firm that's first rate in both. And many questions really are not just investment banking or just strategy. They really combine the two. What we're going to do is we're going to walk through about five issues here, and it's just going to be a conversation. And we're going to leave time at the end for Q&A. And I think the way you ask a question, you can type in a question in the Q&A chat box whenever you wish, if it occurs to you, and then we'll be able to see those questions, and we'll make sure we have time at the end to address those. But the five topics we want to talk about, one is geopolitical, what's happening, the conflicts in the world, China, oil, et cetera. Second, we're talk about industry profits, capacity utilization cycle. Where are we from an industry perspective in terms of changes that are going on? Third, we're going to talk about the stock market M&A, which has been a roller coaster in terms of what's up and down. And we're going to talk about what has happened and also what does that mean for those of you who are involved in senior management. And then on the fourth, we're going to talk about winners and losers of the industry. And this is actually an interesting topic because depending upon who the winners and losers were 20 years ago, generically, quite different than today. And in part because of the things we will be talking about in terms of structural changes, et cetera. And last, we'll talk about environmental regulation, sustainability, net zero, energy transition, and what impact it's having on the chemical industry. So I think you can all agree that that these are topics of great importance, and they're all in flux, and they're all topics that are very important if you're in senior management or if you own a chemical business and are trying to navigate this increasingly disruptive world. So, Rob, let's start out with the geopolitical. I'll let you start first and just say, don't take the entire hour talking about geopolitical, even though you could.
Yep.
But what do you see? What's your perspective on this kind of geopolitical picture, and as it's relevant to those people who are running chemical businesses?
Yeah, I think it just sort of stepping back for a bit. I think you have to start with, as you said, what happened last weekend in Israel with the Hamas attacks, and it just shows. I think goes to increasing the level of geopolitical uncertainty and volatility and the impact that that has. Obviously, not much direct chemical impact as we sit here today. Clearly, obviously, there's some significant bromine production. There's a relatively small cracker and some polyolefins units. But I think, the big question is what this means for the Middle East, what this means for oil and OPEC. And, if this does, you have to be aware of the risks of this becoming a broader, regional conflict. If Iran gets involved, if Lebanon gets involved, and what happens in Egypt, and how this plays out over the next days and weeks. So it's just another that just sort of adds to the volatility and risks that geopolitics bring. I think it just, the last, you have to be aware of the downside risk. I think clearly this brings some downside risks. And then you lay on top of that what, had we had this discussion 2 weeks earlier, certainly with decoupling is a significant risk for the chemical industry. More than half of the incremental growth is going to come from China. There's companies are making some significant investments. BASF is building a massive complex in China. Exxon as well. Shell, Aramco all have significant expansions there. So it's a geopolitics is always front and center for chemical makers as you evaluate your business. But I think it's just incredibly complex, volatile, and I'll leave it there. Peter, what are you seeing out there, Peter? What are you telling?
Yeah, I think there are a number of big categories of things that are changing. I mean, just a couple of them, worth mentioning. China. What's happening with China? What's happening with the China economy? Is it going up, down? Is it going to resume growth? There's obviously a big disruption in energy and oil, and in terms of it's getting very hard to predict what's going to happen to the price and supply of oil these days. Very, very difficult. But then supply chain issues as well, as people try to figure out how to onshore things or to shift where they get the raw materials from China to other countries so they're less dependent. And then Europe with all these issues related to the Ukraine war, where first the supply of energy and then the price, and now maybe supply seems to be better, but still price is still high. So, and then the whole overall economic situation where some parts of the world seem to continue to grow, like the US, but others are struggling. I think in Europe is struggling, and Germany actually technically went to recession. So this adds up to a long list of political, energy, supply chain, economic issues, and on top of that, the significantly higher interest rates, which affects anyone who's borrowing. So you add all those, and it's a long list, and that's not even a complete list. And the challenge actually is, if you are in the C-suite, it is very difficult to project or predict how each of these things are going to, how they're going to evolve over the next couple of years. So it presents a big problem. The only thing is you have to be able to be resilient and figure out how to adjust if a different scenario happens on oil or a different scenario happens on the Chinese economy.
I would agree. I mean, I obviously I should have also, obviously the war in Ukraine and the impact that the energy crisis has had in Europe. There's a long list of things that you have to be obviously aware of and closely monitor, and it just shows the need to be flexible and have options in planning.
Yeah, that's right. Now, switching to the second one, because obviously we could spend 40 minutes just talking about the geopolitical situation, but the reality is there are a lot of disruptions, and they're not going to end, and they're going to be very difficult to predict. How about let's switch over to industry profits, the cycle, capacity utilization. what are you seeing if you look across the chemical industry, uh, how people are doing profitability wise, and what are the distinctions, whether it's the kind of product or the geographic location and so forth, the company?
Yeah, I mean, it does vary by location and certainly by geography, but I think if broadly, globally, we're in a down cycle, certainly since the end of 2022, chemical uh, margins have declined, chemical profits have declined. Demand has we'll say, underperformed. There, you've had some declines in segments, but let's roughly call it flattish. But profits and margins have fallen at a much sharper level. So clearly, I think broadly, globally speaking, and we'll go down into some of the regions and the segments. I think the market is still trying to find a bottom. I think the indications are that we're not quite there yet. I mentioned the weak demand. I think that's been exacerbated by what's happened with destocking that continues to play out. I think there was a hope that that would be a first half phenomenon, but what we're seeing so far in the third quarter, it may have moderated, but you still have destocking. That said, if you look by region, the U.S. is uh, margins are below what they were at this time last year, and profits as well. But the U.S. is holding up relatively well. I was looking at the census QFR data, and if you look at second quarter 2023, this is for the broad industry. Profits are actually above where they were in second quarter of 2019, so before COVID. But it certainly feels like we're in a downturn because we are. I mean, they certainly from the third and fourth quarter of 2022, profits have continued to decline. But in the U.S. at least, even though we're off from where we were in that surge after COVID, things are coming down. But things aren't terrible in the U.S. thanks to its cost position. If you look globally, there still is on the petrochemical side, there still is margin there, unlike what you're seeing in Europe and Asia, where there's the margin is in Asia it's zero. In Europe right now it's slightly negative. And you've seen significant differences by region. The U.S. is certainly down, but margins are okay
Yeah.
in the downturn. That's not the case in Europe and Asia, where certainly on the petrochemical side, certainly on the olefins and aromatics, there there's oversupply. Companies are operating at losses, but in the U.S., there's still incentive to operate. The margins are still there to support exports. Um, you know, don't think anyone would say margins are at an attractive level where they want them, but the U.S. still can operate.
Yeah. Yeah. And actually, if you think about it, first of all, if you look at the geographic difference, clearly, I agree with what you're saying, but clearly the reason why the Chinese companies are making less money and the reason why the Europeans are making less money are not exactly the same. And
Yeah.
Europe, fundamentally, just their manufacturing cost position is higher. And so they are get hit more in terms of profitability if there's a downturn in pricing and demand. China, their cost position is not as high as Europe. They don't have the feedstock advantage that the U.S. companies have, particularly in petrochemicals, but they're getting hit because of overcapacity and reduction in demand because there was a lot of buildup of capacity in China. So the reasons are different. Of course, the big distinction is the difference between commodity chemicals and specialty chemicals, because clearly the dynamics are not the same. I mean, I think they all are suffering from weaker demand. So whether it's specialty chemicals or commodity chemicals, weaker demand hurts. But I think in commodity chemicals, you've got significant increases in capacity that have been a significant factor and will be a significant factor for a while. And they also, a lot of the producers who geared up to supply the China market, I know that's true for a lot of the commodity chemical plants on the Gulf Coast, their ability to compete in China and the drop in demand in China, obviously has been particularly a problem. Specialty chemicals is a shorter list, but still a list. Whether it's not just demand, but raw material costs and so forth have been a factor, and that'll continue to go up. So both the specialty and the commodity chemical sectors have suffered, but they're just different variables that are affecting them. Would you agree with that, Rob?
Yeah, I mean, absolutely. And on the commodity side, I can add a few data points here that, the S&P Global forecast assumes a need for about 15 million metric tons of capacity to be shut by the end of 26 to bring the market into balance. So the base case is that the market remains oversupplied through 2024 into 25. And you do have significant capacity coming on over the next 3 years that peaks in 25, 26, around the time when the BASF, the Exxon plants are the separate crackers are set to start up in China. Plus, there's wholly owned China units as well. So there's a significant amount of ethylene capacity coming on in China. So elsewhere in Asia and in Europe, there's going to be a need to consolidate before recovery does take hold. And just come back to the difference by region. The U.S., the ethane advantage, NGLs broadly, is incredibly strong. So the U.S. will be able to sort of manage their way through this, whereas Europe and Northern Asia outside of China, as this capacity comes on. So if you look at Korea, there's some probably steps that can still be taken in Japan. Some capacity will have to come out to sort of balance the market on the commodity side.
Yeah, that's right. And we're going to talk more of this later when we talk about environmental issues, but obviously on top of this, the commodity chemical producers are having to deal with net zero,
Yep.
requirements, sustainability requirements, and single use plastic, laws that are being passed and regulation and so forth. So that's on top of, everything else. And a couple of CEOs have publicly said, we're going to do what we have to do, but the return on investment on these is generally you don't get a return. You get to comply with what the regulators and the general public want you to do, but we're spending billions of dollars to reach those goals, but they don't necessarily have returns. So that's particularly for the people in the plastic sector, particularly a challenge.
Yep.
Do you see how long do you think this down cycle for commodity chemicals is going to last?
I mean, the there's still more supply coming on. Demand remains weak. So I think the good thing about chemicals broadly is that it still is growing at slightly above GDP rates. So there is an ability to grow its way out of it. But the base case for S&P Global, and I tend to agree, is that we're probably looking at 25 at this point. That there's probably we're near a bottom. Things aren't going to get significantly worse unless we do tip into, unless there isn't some kind of shock to the system or a global recession. But we probably stay along the bottom here through, let's call it the next year, through into certainly into late 24. Maybe in 25 you start to see some kind of recovery. So I think short answer to that is we're probably near the bottom for 12 months or so.
Yeah, that's right. By the way, we tend to comment geopolitically on China, the US, and Europe, but the reality is the rest of the world, is a big place. So a lot of the other countries, Brazil, emerging markets, so forth, in general, it's been a challenging time as well for those players in the chemical industry who are in those sectors, those countries, because many of them, most of them, are struggling with economic growth. Would you agree, Rob?
Yeah, definitely. And I mean, Europe, China there is growth. It's very weak. Obviously, Europe is weaker. The U.S. is relatively stronger, but also as you look at broader GDP, looks okay in the US, even looks okay globally. But I think that the thing to separate there is the difference between what's happening in services and manufacturing. On the manufacturing side, industrial production, 1 or 2%, is effectively at recession type levels. If you look at the global GDP numbers, that's being offset by continuing strength in services. You mentioned inflation earlier, that's starting to sap that in services. So if you see services start to come down, then GDP is at risk. So if you look at the GDP number, it looks decent, okay, but that's being driven by services right now, not manufacturing, which is probably safe to call this that we're in a manufacturing recession globally.
Now let's switch to the stock market M&A. So, I have a view, and I know you have a view. How is the stock market treating the chemical industry? And I know there are differences by region as well, but what's your feeling about how they're doing in the stock market?
Yeah, I think broadly tracking. I think chemicals as a whole is slightly lagging, but it's obviously been a tough market, tougher market on the commodity side, on the chemical side than in the broader market. I think the market's still up for the year, but the last month or so obviously hasn't been that attractive. So I mean, chemicals have not quite tracked what the broader market is doing, but it's lagging the broader market.
Yeah. Our view is first of all, most people, they divide the chemical industry into commodity, specialty, and fertilizer, right?
Yep.
5 groups. We actually done a lot of analysis, and we actually think there are 6 distinct groups, where it's very, very logical to group people that way. But putting that as where their valuations are different, and you can actually trace why. But if you look more broadly at the more traditional rankings, the commodity chemical companies really got hosed, for a while there. In fact, they were trading at average multiples that were very low, 3 and 4 times EBITDA. Obviously you have to adjust for cyclicality and so forth, but extremely low. Specialty chemicals tend to do all right. They were up in like 12, 13 times EBITDA and so forth. And then fertilizer, of course, a small group, and marches to its own drumbeat. But the only thing that then has changed is that the stock market stops, standing on the throat of the commodity chemical companies, and their multiples have come up some to 6, 7 times. Especially hasn't gone much anywhere, in general, we went through a difficult period, and now it's a little bit better, but still, the stock market generally is not doing well. One comment in China, the stock market has suffered because of the whole downturn and so forth. So whereas there were a lot of Chinese IPOs and so forth, clearly the relative valuation and public company values have suffered quite a bit because of the gloomy prospects in China. But I would just say right now, it's not great for chemical companies in the stock market, but it's not as bad as it was maybe a year or so ago, particularly for commodity chemical companies. How about on the M&A side? What are you hearing from companies and colleagues on the M&A side?
Yeah, I think because talking here to Peter Young, but I think if you look at the actual activity on a volume basis, it's okay. I mean, there've been some, clearly, obviously, borrowing costs are up. Presumably the return targets are up, but I think activity continues. I mean, we haven't seen much of a drop off. I mean, there still is a need for companies to either to clean up their portfolios or to strengthen their portfolios. So the strategic need for M&A has gone away, and I think that shows up in the volume of deals. I think, and curious to your thoughts. Large scale M&A has been somewhat challenged. I mean, if you include obviously distribution, and Apollo is doing some interesting things with Univar. But I think the companies continue to assess and look at M, broadly at M&A for strategic reasons, and it continues to happen.
Yeah. What we do, we every quarter we do our proprietary analysis of stock market, M&A, et cetera, since 1986 when I was running the Salem Brothers Chemical Industry Group. And what we see is we had a couple of years ago, we had a peak both in numbers of deals. We had like 109 deals above 25 million in value. We because of some big transactions, we were at 155 billion. A lot of that was the Dow DuPont rearrangement and so forth.
Yeah.
But since then, it's come down. Not to it, last year was not a trough period, but numbers of deals went to 86, so well off the 109 a number of years before, and dollar volume was 52 billion. Not small, but
Yep.
sort of was like moderately healthy. A trough year could be at 20 billion, and in 25 deals. Now, the interesting thing that's happened at the beginning of this year is that the market just froze. In the first quarter, it just froze because interest rates had gone up. There's still a lot of geopolitical and other business turmoil. People were doing things they had to do, whether either for strategic reasons or otherwise. But the other problem is valuations that had been very high for both commodities and specialties were stuck up there, and buyers said, well, we think the values are lower and we're not going to pay more than what we think today's low value is. And sellers are saying, hey, wait a minute, I'm not going to take $1 less or €1 less than what Joe Blow got for his polypropylene business a year ago. So the market kind of froze because buyers and sellers couldn't agree on price. So as a result, the first quarter just really fell dramatically in terms of numbers of deals and dollar volume. I think there was only 8-point-something billion in the first quarter and 16 deals, whereas the average quarterly volume is more like 20 to 22. Second quarter got interesting. We thought, wow, there's maybe a revival. The number of deals went up that quarter to above the average, and the dollar volume went up in part because the DSM-Firmenich deal was completed, right, which was a fairly large deal. Now, we thought it was going to keep on chugging to a higher level, but we just yesterday, we completed our analysis of third quarter, and the number of deals went down again, and the dollar volume went down again. So it's a little hard to predict what's going to happen. For a while there, we were cautiously optimistic that, that there was an upturn in the M&A market. Now we're not entirely sure. On the other hand, the backlog of deals announced but not closed is around 34 billion. So I guess it's not entirely clear where we're headed. I think that this year will probably be will be greater than last year on a dollar basis, but very heavily influenced by the DSM-Firmenich deal.
Yeah.
In numbers of deal will probably be less than last year, so below the 86. But where the exact trajectory is a little hard to tell because so many of the things that drive M&A are moving in different directions, whether it's interest rates or the price of oil, economic growth, uncertainty about China. So I think it'll take a little time to see where we're headed. Good news is we're not at a trough. There is a market out there if you want to sell something, unless it's a very loss-making commodity chemical. But whether it gets to a more robust and healthy stage is hard to tell at this point. You know?
And actually, one thing back to valuations and sectors, curious to get your thoughts on the industrial gas guys, because I mean they've continued to grow through this. I mean Linde's up 17% this year, looking Air Liquide's up 22%, Air Products is down a little bit. But if you look at the valuation of Linde, they're approaching 200 billion, which just is shocking. Air Liquide's at about 90 billion. They have 300 billion between the gases companies. So that's starting to distort the valuations for the broader the chemical markets. These used to be relatively smaller companies. Obviously, there's a lot going on in hydrogen, but the one thing that stands out in terms of performance is what the industrial gas guys are doing, and they continue to power through this thanks to what's going on in hydrogen. Lithium's another example. You've had Albemarle down sharply this year, but obviously they've grown a bit, but the industrial gases continues to be a standout in terms of performance, certainly within the chemicals and materials sector, and even the broader market. They just continue to outperform, and it's starting to distort I think the chemicals and materials indexes, because you have Linde alone at 200 billion. You add in Air Liquide, they're approaching 100 billion. Those valuations alone are probably start to make up the next 50, 60 companies combined. So that's the outperformance of industrial gases, and obviously it's the reason it's happening is hydrogen. It continues to remain interesting, and whether that continues.
I think the industrial gas sector has always been a bit of a problem to figure out where to put it, because on one hand, it's a commodity chemical, right? In other words, air products, oxygen looks just like Linde's oxygen and Air Liquide. On the other hand, the structure of the industry is very concentrated, and so you have a commodity chemical business that is an part oligopolistic structure, so they make more money and a more relatively more stable basis than people who make polypropylene. So you have to sort of, it's not as extreme as fertilizer, and fertilizer is so different. We said it can't be in the same index as commodity chemicals because it distorts. So we've always set them out as separate. But you're right, industrial gases march a different drug beat, and it's like on that, it's got some characteristics that are more like Microsoft and Google, but unlike them, the products are all the same, so they're commodities. So it's sort of in between. But the overall, I think your comments about the overall market are correct, and as far as the market is concerned, I guess the question is, what do you do if you're running a chemical business? I would say this: if you have a commodity chemical business that you're trying to sell, unless you really have to sell it, or you have one or two people there's a huge amount of synergy, this is a tough time to sell, because evaluations have come down significantly, and there are a bunch of folks who delayed selling commodity chemical business that from last year to this year, and they regret it, right? Because they might have been able to sell last year at a certain price, but this year's tough at a much lower price. On the specialty side, although valuations have weakened some, they're still reasonable. So if you're want to sell a specialty chemical, this is not a bad time. It's not a peak time, but it's not a bad time. And if you're buying a specialty chemical business, you won't buy it for a cheap price, but it's not going to be at the total nosebleed prices that we were seeing for a couple of years, ending the end of last year. So there's some clear, implications for people. Are you seeing the same thing from a valuation point of view, Rob?
I agree. Yeah, absolutely. I think, as you said, it hasn't significantly impacted deal activity to this point, and the valuations have clearly the valuations have come down a bit, but it hasn't been significant.
Yeah. Well, one thing's for sure is certainly the private equity share of acquisitions obviously had weakened, because they have to adjust to the higher interest rates and just the availability of high yield debt. And obviously Europe, because there's so much uncertainty and a weaker economic situation, that has not been the hotbed of M&A transactions either, but really for pretty straightforward reasons. So, more of the transactions are in Asia and in China and in the US. And, that kind of makes sense. China, because they have to consolidate, they have too many chemical companies. US, just because it's a healthy chemical industry. Now, a different part of your crystal ball, Rob, and that is, who are the winners and losers in the industry going forward, to the extent that you can characterize that?
It's start with the losers or the more challenged. I think one thing, start in Europe and specifically, you know, Germany. A, I think the next few years are going to be incredibly challenging for Germany, for a few reasons. I mean, starting with the Russia-Ukraine war, the loss of German gas and the energy crisis. Clearly, that's created huge problems from Germany from a cost perspective. And if Germany was one of the few European markets that could successfully export globally. That's what BASF's business model was oriented around. And if you look at the announcements that they've made, is they're reorienting their own production, even in Leverkusen, around European demand. They're not going to continue to seek to export from Germany. Obviously, they've shut ammonia, anything gas-based. They've where they can, they're already starting the consolidation on the ammonia side and other products tied to gas. So I mean, I think right now loser is a tough term, but I think they're more challenged, and I think it's a situation that's going to play out over the next few years. I think it started with the energy crisis. Then, if you look more broadly at what's going on in the automotive sector, which is, I think, still the largest end market for chemicals demand. The the transition from internal combustion engine to EVs, that puts Germany for now seems to be on its back foot there as well. I think that creates problems for German chemical makers and European chemical makers. And I think they have to continue to work through that. I think broadly Europe uh, is similar to what Germany has to do. I think outside of Germany, it's been happening already, but they clearly have to adjust their production footprint to local demand. So I think that's happening. That said, if you look at companies like Ineos, they imported ethane is actually incredibly cost competitive. So there, if you can import ethane and LPG, you still can have a viable, uh, you know, commodity chemical business. And I think LPG ethane margins, the forecasts are relatively strong. I mean, imported ethane into Europe is pretty cost competitive. I think, keep an eye on what's happening in China as well. Clearly, the economy has matured and it's slowing, so you're not going to see the high single digits, low double digits that we saw 10 years ago. Great. So they're starting to, what does chemical demand look like in a world where underlying Chinese chemical demand is at 5 or 6%? So I think that obviously impacts, given the oversupply in the market now, that impacts China, but that also has huge implications for what's going on in the global chemical industry, since that is the the incremental driver of demand is still Asia, including India, as well. I mean, I think if you look at the winners, I mean, the U.S., thanks to its cost position, I think, has the ability to endure through downturns like we're seeing now and still maintain decent profitability. Clearly, there are geopolitical risks if decoupling does continue. If we get back into tariff wars, clearly that could complicate the situation. But right now, the U.S. has a strong ability to export. I mentioned, India is, I think, another. If you look at their current forecast and their near-term forecast, some of the certainly strongest growth in the world is coming out of India right now, and over the midterm the near to midterm, that doesn't change.
Yeah.
So on the downside, certainly I'd say Germany and Europe, and to some extent China, given how it's maturing. But I think the winners continue to be the U.S. and I'd say India.
Yeah. Yeah, I have some similar views with regard to the winners and losers. First of all, a big part of the story always is for customers,
Yeah,
where are they located? So, for example, if you're a major leader in textile chemicals, even if you had the best products and you have pretty good costs, if you were in Europe, eventually you were going to be eroded away, right? Because uh, the clothes and all these things were being increasingly made in China. And yeah, sure, theoretically, a Chinese textile manufacturer might want to buy from you, but gradually, uh, the local guys will take share from you. Um, Electric vehicles is going to be something similar, because
yeah,
fundamentally, although the BMWs and the Mercedes have brand recognition and they have a strong reputation in the high end of the market, the reality is there's like 500 Chinese electric vehicle manufacturers, and they're not content just to make the low end inexpensive. They're going upscale and they're producing luxury EVs, and they're starting to flood the European market. So there's a point where, and as a result, now there are inquiries about whether the Chinese government is subsidizing them and so forth. The only reason why it's not happening in the U.S. is because the U.S. has huge tariffs, right, on
yeah,
electric vehicles coming from Asia. So we haven't been hit in the U.S. So there's a case. It's a little like Texaco. So you know, and who's supplying the Chinese market for the vehicles that are being made there that are going to be
yeah,
exported into Europe? There's a question mark there. So I do think that there's some movements in major markets that consume chemicals, geopolitically, geographically, that may hurt Europe in the model. And let's face it, part of the reason why Germany did well is because by creating the EU, the currency, it favored them because they were a joint currency that was below what the value would have been if they were just selling in German marks, right? So they benefited heavily from the formation of the EU, but that gets eroded too. So I think structurally there's an issue, as well as costs and regulatory. I think one of the problems, and I don't know whether you call it lose or not, is the heaviest regulation on environmental and all these things are in Europe. Now, is it good for society? Maybe. Is it bad for the German and the European chemical producers? Yes, on a relative basis, right?
yeah,
Uh, the other losers, quite frankly, is they're going to be a bunch of losers in China because they have too many companies. So although ultimately they're going to consolidate and they've got some industry leaders, a bunch of the guys are just going to are not going to do well and get consolidated, and that's what we're seeing. The other possible losers are the people who made big bets in China, not necessarily knowing what was going to happen with Xi and this increasing Chinese government control over the economy and regulation and all these other things. And so it's a big question mark for a lot of the people who are building very large plants in China. And it must be an enormous source of heartache, a headache, about whether the bet 10, 20 years from now, it will have been the right bet.
yeah,
So that's not a complete list, but winners, I think clearly the U.S. chemical industry is a winner because they're tied to a very strong economy and they got a low cost position. Are they have a perfect position? No, but certainly I'd rather be a good cost a U.S. chemical company with good cost position than a German chemical company, uh, you know, or so forth. We have a question here that actually, Rob, we might as well take it because you started talking about it. From anonymous attendee number one, he or she says, can you comment on India, more bullish than other economies in the region? I've accelerated that just because you already started touching on it. You want to comment on that question?
yeah. I mean, I would, yeah, sure. I mean, I think the current performance of India is, I think, the strongest globally, certainly among developing markets, and certainly, obviously, developed markets as well. And the forecast is that continued. I mean, that looking at some of the S&P figures, that real GDP in India continues at above 6% through near the end of this decade. So, and industrial production, I think, is that slightly higher, is in the high fives. So it's, there's, as long as I've been a Chemical Week, as long as I've known you, people say, keep an eye on China. Keep an eye on India rather. India's the next China, and given that China is maturing and downshifting, is this the time for India to take an even more prominent role in the global stage and within chemicals? And I think you're starting to see that clearly. Direct investment in India remains a challenge for companies in the U.S. and Europe, but from a chemical industry perspective, it's a decent market, and it continues to grow. I mean, it's the standout, I would say.
Yeah. My view about India overall is I'm optimistic about India, and I think it's going to do well. And the economy is going to grow faster than most economies. And I think there's kind of a turning point, maybe for India today in terms of its relative cost of its labor. Certainly, it's now surpassed China for the first time in terms of the number of people in the country, et cetera. But I think the caveat is that India has always been a kind of a problem to get it out of the starting gates, right? Because they've always had something that's held them back as an economy. And first of all, the internal infrastructure and transportation, so forth, supply chain is not nearly as sophisticated and well-oiled as in China. I mean, China did a very good job behind the scenes investing in infrastructure to allow suppliers and so forth internally. So they built a wonderful supply chain and the ecosystem was pretty complete. The other issue in China and India is, behind, whether it's, power generation, whatever. They share the problem with China in that neither China or India has major supplies of oil and gas. I mean, I think China has some oil, India has very little. And that obviously is a structural issue that there's not much India can do other than, well, they're certainly now buying oil, at low prices because of the current situation. But that's going to be one of the possible Achilles heel going down the road, just because when it comes to that part of the industry and making plastics and ethylene and so forth, they've at least historically had a handicap. And water supplies, same kind of problem, right? Which is probably worse than China in terms of supply of water. So on the other hand, you have a well-educated population, terrific engineering class, a very significant number of people who speak English as well as a second language. So it has a lot of the things that would allow it to do well, but it's always had one or two things that's held it back. So I think the key is whether they can get around the couple of Achilles heels that have been holding back. I'm hopeful that's true, because I do think it should be, this should be the next decade or so, time for India to shine, I think. And they certainly have clearly shown that for whatever reason, they're very good at managing, right? I mean, look in this United States, we have more Indian Americans who are CEOs of major companies in the US than we have pretty much any other ethnic group. So, and there's a reason for that. So hopefully that will help India succeed, as well.
Dude.
Now let's move now to the last question, which is environmental sustainability, net zero energy transition. So Rob, since it's one of the more difficult questions, I'm going to ask you to comment first, and then I can clean up right afterwards.
Yeah, I mean, I try to where to start and to where to end here. I mean, I think it's the last 5, 10 years. It's become a the question that has to be addressed at the top of the agenda for chemical makers in terms of how to manage the energy transition. If you look at outside of China and India, um, nearly every company has committed to net zero scope 1 and 2 emissions by 2050. Few exceptions there, but I think the latest figure we can start to track this is that close to 90% of US and European companies have scope 1, scope 2, 2050 net zero ambitions. Scope 3 is starting to develop. But the question is, how does the industry get there over the next 2 or 3 cycles before this is clearly electrification is going to play a part, feedstocks are going to play a part. You've had somewhat of a backlash to against ESG, but I don't think this is not going away, and it's not. If you look at the commitments and what the industry has to do over the next starting today and over the next 20 years to get there, I mean, it's significant. Clearly, electrification is going to be a part of that. Bio and renewable feedstocks are going to be a part of that, and offsets are going to have to be a part of that as well. I think you mentioned earlier about what that does to returns, and so is this how who pays, so to speak? So does are we entering a 1 or 2 cycles where returns are lower because of the required investments and sustainability related to energy transition? I think that's the big question in terms of who pays. Europe is looking at things like energy, clearly carbon border adjustments, and what does that have on impact? Does that have on imports from China and India? Is a question to play out. So it's strategically, I think it is the huge challenge. I mean, that said, hydrocarbons are not going away. The world is not going to dematerialize. There's still going to be a need for hydrocarbon feedstocks, from 2050 and beyond, and how the industry continues to operate while meeting these targets is a big question. Clearly there'll be on the feedstock side there'll be a shift to renewables. On the output side, hydrocarbons are not going to go away. There's still going to be a need for hydrocarbons. I think we're early stages here in terms of technology development and investment development, but I think it is the strategic challenge of our time.
Yeah, no, I think it's going to be a big deal.
Yeah.
It's a big deal today, and it's going to be an even bigger deal going forward. I think every CEO and every C-suite has to spend a significant amount of the time thinking about this issue. We're actually finding that whereas on M&A deals, it was standard that you would check on the environmental and on issues and spills and everything else, compliance with regulatory. Now the list is on things related to net zero, et cetera, sustainable. Now that list has become much longer in terms of what people have to do due diligence. The challenge though is that a lot of the solutions for these things are just going to take a lot longer to implement. I mean, you mentioned, Rob, things not made out of oil, right? Out of biomass, out of other things. The challenge there is it's taken a lot longer for those guys to get up and running. It turns out, it's not like you can retrofit your plant to suddenly make things using biomass. You got to build a new plant, and that creates a huge expense. But a lot of these folks, they've got technologies, they work, but it's not clear where they work on a large scale.
Yeah.
right? And the volumes we're talking about, particularly in plastics, are huge. I mean, how do you replace billions of pounds of polyethylene or polypropylene with non-oil based renewable raw materials? I think that's going to be tough. The other struggle, of course, is on the other end, which is it's they're still trying very hard to make the whole recycling thing work. I was saddened to hear that in the US, yeah, they sort all this stuff, but 90% of stuff just goes into a landfill. So you sort it on your end, as a consumer, and I guess, and then when they collect it, they throw them all together and send it to a landfill. It's kind of pathetic, right?
Yep.
But it's it's that whole the technology and the systems are just not there on a scale basis to handle the volumes that we're talking about. So I do think that it's going to be a challenge in the C-suite. It has definitely got to be on the top 5 list of things you got to worry
Yeah.
about. But how all these things are going to get solved uh, is not totally clear.
Yeah.
Would you agree, Rob?
Yeah. I would add, I thought Exxon last month had an interesting presentation that showed, and again, these were internal. It is ExxonMobil, and these were some of their forecasts. They didn't attach a specific date to it, but clearly it was 2050 or after. That if you look at basically their refinery output, you know, 10-12% today is accounted for by petrochemicals. As you look as energy transition plays out, that increases to 55%. So it's clear that hydrocarbons do not go away. Clearly, renewables increase, gasoline decreases, but there's still going to be a need for diesel, for the materials that for the inputs that make uh, chemicals and everything around us. So the expectation is that chemicals will continue to grow at faster than GDP. That will make up more of the barrel, so to speak. So you'll see a hydrocarbon shift, but more of that will go into chemicals. And there's as we sit here right now, there is no substitute. There is certainly the share of renewables will increase, but you know it cannot account for everything or near everything. So it's how industry manages that and is yeah, it's the puzzle that has to be solved, and it's clearly I think at the top of every company's agenda.
Yeah, that's right. Now, we pride ourselves on starting on time and ending on time, and we have like a minute left before the end of the hour. And so, Rob, I didn't say I was going to ask this, but I will. It's not an unfair question. Do you have like a 1 or 2 word takeaway for the audience on this general topic of, what the future is going to bring? Do you have it could be 3 words, could be 2 words, but not 8 words, right?
Yeah, that said, clearly the industry itself is in a downturn, but I think longer term uh, the demand is still there for what the industry makes, and the role of the industry that will play the positive role, the enabling role, in things like energy transition. If anything, that's continues to increase and intensify. So I think the short answer there is clearly we're at or nearing a bottom of the cycle, but longer term, um, I, I don't think underlying demand has not been diminished. I think if anything, energy transition offers new opportunities. I think there clearly will be winners or losers here, but if you're well positioned, if you have the right strategy, there's no lack of opportunities for chemical makers.
Well, Rob, you've had an interesting definition of a 1 or 2 word takeaway,
Sorry about that.
but no, but the insights are good.
Yeah,
I would use the word resilience
yeah, sorry, yeah,
or
yeah,
the word pivot because
yeah,
I think that whereas 20 years ago, it was a lot easier to predict the future. And
Yeah.
so you could do a strategy and maybe have one or two alternate scenarios that you plan around. Today, it's really hard to do that. So you have to be
Yeah.
resilient. The other word I would use is ability to pivot.
Yeah.
And the analogy is if you like watching football or rugby or soccer, is to see the player who goes down and suddenly realizes now there are a whole bunch of defenders, going on the left side, so they pivot, turn around, find a new path, and then succeed. That's really going to be critical. In other
Yeah.
words, to be resilient, but also to continuously assess how the world around you has changed and whether that affects the formula for success or defeat, and then pivot. So
Exactly.
resilience and
Yeah.
pivot, I think, are two words that I would use to sort of say, what's the takeaway if you're in the C-suite?
Yeah.
Well,
I think
Bob, go ahead.
I was going to say, yeah, pivot's a great one, right? What got you here today and what's worked the last 20 years is not what's going to work for the next 20 years. There is certainly a need to pivot. So I think that is a great word to end on.
Yeah, that's right. So, Rob, I want to thank you for being a co-speaker on this fireside chat.
Thank
We
you, Peter.
managed to get through all 5 of the questions on time.
Right.
I also want to thank the audience for your participation. There weren't a lot of questions, so that means either we were very good or we're very bad. I'm not sure which. I hope it's because we were very good. And we will be having Young and Partners forums on a regular basis, and all of you will be invited. So thank you very much.
Thanks, Peter. Thanks, everyone.